What's going on, guys? It's Garrett Fields of Nelson Financial Planning here. In one of my previous videos, Stocks vs. Bonds, we went over how each asset class has performed over a 90-year time period. We talked about how a $100 investment into stocks in 1926 would be worth $587,000 in 2016. We also talked about how that same $100 investment into bonds over the same time period would only be worth $11,800. So, knowing this, there's a glaring question. Why wouldn't I invest 100% of my money into stocks? Well, in today's video, I'm going to attempt to answer that question and explain how external factors have a massive impact on your investments. Before we get started, let's compare the two asset classes again as a recap. Above is how the two asset classes did from 1926 to 2016. So why would you invest in bonds if you know there's a good chance they're going to get outperformed by stocks in the long run? The answer is emotions. Here's two articles that talks about what investors did during the 2020 stock market decline. This first article talks about how a record number of dollars was pulled out of the market on March 13th. This is just 6 trading days before the market hit its bottom, turned around and had an incredible run that ended up being the best 12 months the market's ever had. It rocketed up over 70% from March 23rd, 2020 to March 23rd, 2021. This article talks about what investors did with their money after pulling it out of the stock market. The article was published on June 22nd. At this point, the stock market had recovered almost 40% from its lows and had recovered over 15% from where it was on March 13th. So what does this have to do with bonds? The answer is simple. Bonds are by nature less volatile than stocks. Here's a chart that showed what stocks and bonds did during the 2020 stock market decline. You can see that while the stock market dropped over 35%, bonds stayed relatively flat. And while the stock market did outperform bonds, you would only get that performance if you stayed invested during the entire time period. So in conclusion, we know that people tend to sell their portfolios when they're losing money because their emotions are running high. And then they struggle to get that money reinvested. So the point of bonds are to smooth out the volatility of stocks so you can keep your emotions in check during the deep declines that the stock market occasionally has. If having bonds in your portfolio keeps you from liquidating your stock position whenever the market takes a decline, then you would have a better rate of return than if you had an all-stock position, liquidated when the market took a decline, missing out on the recovery, and then struggling to get that cash reinvested. This is why it's so important to sit down with a professional that understands what your long-term goals are. These people can help you manage your stock and bond positions, as well as help keep your emotions in check when the market does take its occasional decline. So feel free to slide into our DMs, email or call us with any questions you might have, or set up a free consultation. We're always here to help. And as always, stay safe, stay healthy, and invest consistently.